Hello everyone, welcome to our discussion, part two of our discussion having to do with itemized deductions. So we did medical expenses and taxes in part one. So here we're going to do deductible interest as well as charitable contributions and then some miscellaneous. So first of all, interest on a loan or home equity loan secured by a qualified residence is deductible. Now, notice it has to be the loan proceeds need to be used to either acquire your house or fix it up. So that other uses of the money are not going to make this a qualified interest. So for instance, if you get a home equity loan on your house and go take a vacation, that used to be deductible but is no longer. So now it is much more specific about what you use the money for. And there's a limit on the amount, $750,000 for 2020. Now if you go back to 2017, the limit was $1 million. And so if the loan was in place back then and you're still paying interest on it, it could still be deductible, even exceeding the limit. But any new loans, $750,000 is the maximum. Now that is a combined of all the loans. Now, and again, it has to be home improvement indebtedness. As long as the home equity loans don't go over this and are used for this $750,000 limit or the value of the house, that's the other limit. You can't borrow more than 100% of the value of your house. Then it's deductible in this situation. Now, there's an interesting thing about this that not that it comes up a lot, because $750,000 is a lot in terms of that limit, but as houses continue to get astronomically expensive, that it becomes more of an issue. But there's a question as to whether that was $750,000 per house or $750,000 per taxpayer. And there was an ongoing fight, and this kind of shows how tax law is made and adjusted. IRS disagreed and with various taxpayers, and it went back and forth. It went to the Court of Appeals, tax court, then the Court of Appeals, and the IRS lost. And they basically came back and said, all right, we're going to acquiesce to that decision. From now on, it's going to be on a per taxpayer basis, not on a per residence basis. And we were, I mean, they don't actually say we were wrong, because remember, we're trying to interpret a law passed by Congress. It's not that the IRS says they're wrong. He said, we're just going to stop fighting. Okay, so you can go along with this and you don't have to worry about us taking another person or taxpayer to court on this. Okay, so that's kind of it's a big deal for those where this could apply, in that each two single individuals could both own $750,000, as opposed to a married couple. They would be limited to the one $750,000. So it's just an illustration of how the kind of the give and take between taxpayers and the IRS, and also how it works when it goes to court and is decided in the Court of Appeals or a tax court. Other items of deductible interest. This is important when you buy a house or refinance. Points is often charged by the lender, and it's usually as a percentage of the loan principal. Sometimes it can be called origination fee or whatever, but it's based on the amount of the loan. And if you buy 2 points, it usually means that you're going to get a lower interest rate throughout the loan. So that is typically reported properly by the lender, and they'll send you the 1098 that shows how much you paid in points. But you should be aware that that could be a significant amount of money right at the start of a loan. Okay? Typically, the law says that you have to deduct those points over time. Even though you paid them all up front, you have to deduct them over the life of the loan, except when it's your principal residence, your primary home where you live. If you do it with that, you can take the deduction for the points all at once. And that, like I said, if it's a $300,000 loan, could be several $1,000s that you get as a deduction in the year that you buy the house or refinance it, for that matter. The other thing that may be hidden in your loan and should be reported properly in a separate box on the 1098, okay, is private mortgage insurance. Typically, lenders charge you insurance. Now, I want you to know that this is not homeowners insurance. Homeowners insurance is not deductible. Homeowners insurance is what you buy on your house that's in case there's a fire or some other thing that causes damage to your house. Private mortgage insurance is insurance against you that you buy against you not paying your mortgage. And the theory is you buy insurance, and then if you can't pay your mortgage, the private mortgage insurance company steps in and pays the mortgage for you. And it's generally only if you have less than 20% equity or 80% of the value of the house is borrowed. So that's going to be reported, and it can be deductible as interest, even though it's not technically interest under the interest section. But it phases out for every $1,000 of the AGI exceeds $100,000, $50 for married filing jointly. It's completely phased out for $110,000. So it phases out very quickly. 10% goes away. Okay, every $1,000 over 100. So by the time you get to 110, it's gone, and you get zero of that as a deduction. Investment interest. This kind of last thing of interest. This is when you borrow money to buy investments. Now, first of all, if you borrow money to buy investments that are not going to pay you, that don't pay taxable interest, meaning that you buy municipal bonds or any other investment that pays non-taxable interest, then you can't get a deduction for the investment interest. You can't get a deduction for interest to buy investment where you don't report the income. All right. Second, if you do buy investments that pay you taxable interest or something like that, the amount of interest that you can deduct that you can deduct is only up to the amount of the income you receive from your investments. Now, it doesn't have to be specifically those investments. It could be any investments. We look at the overall interest you earned, dividends you earned as investments, take out any direct expenses like commissions and stuff, and then the difference, what's left over, is the maximum investment interest you can deduct. Any more you pay than that must be carried over to future years, okay, when you have some investment income. So if you borrow money to buy, say, land, and that's your only investment, you're going to have a problem with investment interest, because the land, if it's just sitting there and you're just waiting for it to go up in value, is not going to pay you anything. There's not going to be any investment income from that. And therefore, your investment interest, the money you borrow to buy that land, that interest is not going to be deductible because you don't have any investment income. You just have to keep carrying it forward until some future time when you make some investment income. All right. Deductible gifts to charity. Generally claimed as a schedule on the Schedule A. The value of the property or cash you've given, but there's subject limitations based on what you give, the form of your deduction, a form of your contribution, cash or otherwise, and whom you give it to. And those limits vary based on those two items. So some changes, new things for 2020. Okay? First of all, the cash contributions directly. If you give cash directly to a charitable organization, the limit for 2020, for 1 year only, is 100%. You could give away all of your income, all your AGI for the year, and have a deduction for charitable contributions up to 100% of the AGI. Okay? If you give it to other charitable organizations, now charitable organizations are the ones you mostly think of, but there are other ways, foundations, private foundations, some donor-assisted funds that are kind of a roundabout way of giving to charity. And most folks don't use them, but if you come across that cash contribution is only 60% still, okay? But that's higher than normal for 2020. And then they stuck in this $300 for AGI, which really we could have talked about back in chapter 4, but because we hadn't even really talked about what charitable contributions were yet, decided to have it here. $300, that's the max. That's not very much money, but if you don't itemize, you can still take this deduction. For 2020, it's a 1 year deal. All right, $300. So additional limits come into play, like we said, based on what you give. If you give capital gain property to a qualified charity, Red Cross, a church, something like that, if you give, and we're talking about things that if you sold them, they would give capital gain. So this is artwork, this is stock, this is that sort of types of assets, not cash and not inventory in a business. If you give that to them, now you get to deduct the fair market value of that, but only up to 30% of your AGI. If you give that same stuff to a private foundation, you've heard of things like the Ford Foundation, the Packard Foundation, those are private foundations. You gave money to them, gave that to them, stock or one of those assets, it would be 20%. So you got to lower because it's not what's considered a public charity. There is if you give them a public charity, non-cash donations of non-capital gain, usually inventory. That's usually you donate excess inventory to the charity. That's a 60% AGI limitation. All right? Plus, you deduct the cost of that inventory, not what you could have sold it for. So if you have inventory that you paid $50 for, you know you could sell it for $75, you don't get to take a deduction for the $75, it's only for the $50. All right, generally, if the capital gain property is donated to public charity, the deduction is the fair market value, not what you paid for it. Okay? But there's an exception, and that is if you give tangible personal property. So not stocks or bonds or things like that. That's intangible. Tangible means you can physically, so a piece of art, a statue, something like that. That would be tangible personal property. If that property is sold or put to an unrelated use, you only can deduct the cost, all right, of the item. So if you donate a statue and you donate it to an organization and they just sell it and take the money and use it in their charitable organization, then your deduction is only equal to the cost of whatever that cost you when you bought it. If you donate that statue to a museum and they put it on display, then you can deduct the full fair market value at the time of contribution. So you need, in certain cases, to know what is going to be used to. And you can generally no, if you donate art to an art museum, they're probably going to display it. You donate art to the Girl Scouts, they're going to sell it and utilize it in their in their stuff, and they're probably not going to want that art. They're probably going to not solicit that kind of a donation. The other exception is if you had any of the things you give to charity, any of this property, even stock or bonds, even intangible, you only had it for less than a year. Then you can only deduct the cost of it. So you need to have held it for at least a year to get the full benefit. So what do you have to prove? All this generosity, giving to charity. There was some concern about these items, this scenario, and people deducting things that they really didn't give, or made gifts that they got stuff in return for. For instance, you give money to your college and you get tickets to a football game, or you go to an auction, charitable auction supposedly, and you buy stuff, but you actually get something. Okay, so it's not really a donation in the way it should be. So there needs to be some substantiation. If it's less than $250,000, you can use a canceled check or a receipt. Over $250,000, you need a written acknowledgement from the organization, and that acknowledgement is going to say you received nothing in return, if that's the case. If you are donating or you're buying something at a charity auction, the deduction is only the amount over what that thing is worth that you paid. So you go bid up an item for $500, it's only worth $200. Then you have bought the item and you made a donation of $300. That's how that should play out. Things like donating cars have become more strict, and you now get the charity has to provide a bunch of documentation showing the value of what it was, because people were claiming value for cars way out. The car broke down, it's in your driveway. Yes, it may have been worth $5,000-$10,000 a couple years ago, but now sitting in your driveway without being able to run, it's not worth that. And people were claiming all kinds of donations. Now the charity has to show that they sold it and what they sold it for, and they provide that to you, and that's the maximum. That's the value of that you can use on your deduction. If you go over any of these limits, AGI limits, it only carries forward for 5 years. It's not indefinitely. Casualty and thefts have really almost exclusively gone away. Thefts really are not a thing. You still have casualties, but only in a federally declared disaster area. So it has to be sudden and unexpected. Okay, the property you own gets damaged, and it's not covered by insurance. So you have to always consider what you get reimbursed for insurance. If your house washes away, even in a federally declared disaster area, and the insurance pays for all of it, then you have no casualty loss and no deduction. Okay? And by the way, there is a rule that says you have to apply for your insurance. You can't just say, oh, they probably won't cover this, therefore I won't bother. If that's the case, then you don't actually have a casualty loss. So how do you know how much your casualty is? Okay, fair market value before and then after. If your house is worth $300,000 and it's worth $200,000 after the casualty, then your casualty loss was $100,000. Okay, but it can't be more than what you originally paid for it, no matter what the drop in value. All right, then you have to reduce that, of course, by insurance you receive, and by $100 on every casualty. And then it has to be over 10% of your ADI. Just like medical expenses, that'd be 7.5%. This has to be over 10%. So lots of bad things need to happen for this to work. So these are very rare. Okay, you've got to have a disaster. You've got to have a casualty. You've got to be covered by insurance, and it's got to be enough to more than 10% of your AGI. Miscellaneous itemized deductions have gone away. Deduction for business expenses. So for instance, it used to be deductible for you. If you drove for your employer and they didn't reimburse you, you could take a deduction for that. Other miscellaneous things that you did for your employer that were not reimbursed, no longer a deduction. Okay? So there's only a couple of other itemized deductions that are in place, and the most important of those is gambling losses, because that's so common. So a couple limitations on gambling losses. First of all, they're not going to do you any good unless you itemize, right? If your standard deduction is higher than your itemized deductions, and that's the first thing someone needs to know, because when they ask you that question in preparing their tax return, okay? So you've got, if you don't have some of these other itemized deductions, your gambling losses have to be huge in order for it to qualify. And then it can't be more than your winnings. So you have to take your winnings, put them in other income on the Schedule 1 and then onto the 1040. And your deduction as an itemized deduction as under other, so there should be very few other, just as gambling losses, and the one other thing, theft losses from income producing property, goes on that as other, and it can't be more than your income. So if you had won a couple of jackpots, $2,000, and you spent $10,000 on lottery tickets, the only lottery tickets, and buying a losing lottery ticket is a loss, so that counts, but it would only count for the up to $2,000. So you'd have other income, $2,000, and you'd have an itemized deduction, other itemized deduction of $2,000. It would exactly offset each other. But the other $8,000 would be completely non-deductible, no benefit at all. And technically, you should have evidence. So you need to keep your losing lottery tickets, or now casinos and places like that will tell you how much you lost. Because so much of it now is on a swipe card and is all tracked by the casino. It's not cash anymore, which makes it a lot easier to know what those things are. They'll give you a printout of showing you all the bets you lost, everything that didn't go your way, almost as if they knew you needed that for your taxes, and show you your winnings and stuff like that. They've always had to report your winnings, or at least for several years now. And they don't have to report your losses, but of course they want to benefit your, of course they had to weigh the fact that you're going to now show people how much they're actually losing versus how much they're winning. Balance that with getting a tax deduction. So I'm sure that they hesitated to give all that information. But typically they will. You can get a printout and you can see exactly what happened. That would be what you would use in preparing the tax return. Remember, that's limited to only the amount of the winnings.